In early June, Berkshire made two important investments. The first one is injecting $10 billion to Google's secondary offering. And because the market cares a lot about AI, this investment gained a lot of market attention. However, the second investment, which is acquiring TMHC for $8.5 billion, didn't get a lot of attention from people. However, unlike Berkshire's investment into Google, there is a reason to believe why Berkshire has deep insight into the home building industry. That's because more than 20 years ago, Buffett acquired Clayton Homes, which is a manufactured home company, so Berkshire has inside look at this industry. And this Clayton Homes acquisition is considered successful because of the large profit that the company generated even during the 2008 financial crisis. So today, through the fundamental research, we'll find out why Berkshire is buying American housing and also see how we can invest in this sector. First, let's start with the supply and demand. US population is increasing at about 1.1% per year for the past 75 years. And in terms of households, which is more relevant to the home building industry, the number increased from 44 million in 1950 to 135 million in 2025, which is a rate of 1.5% per year. So even though the speed is slow, demand for houses is very solid. In terms of supply, the industry provided about 18 homes per 1,000 household per year. However, since 2008 crisis, the number dropped significantly, and since 2010, the industry only provided 9 homes per 1,000 households. And even though the industry rebounded a little bit for the past 10 years, the number still remains well below the 18 average at 10.8 houses per 1,000 households. So in terms of supply, we can see that US housing market is undersupplied for many years now. Comparing with other countries like Canada and Australia also provides about 18 to 19 houses per 1,000 households, which is in line with historical US average, but as we saw before, US is undersupplied for more than 10 years now. And this number is quite low considering that even Japan, which has very old age, median age of 50.2 years old, and the country is having decreasing population, still builds more houses than the US. So in terms of supply and demand, we saw that demand is solid, but the market is undersupplied for many years. And from this, we can expect the home building share prices to be high. However, if you look at this Dow Jones Index, home builder share prices have decreased about 30% since its peak in Q4 2024. In order to understand this, we need to look at the second component of home building industry, which is interest rates. Interest rate impacts the home building industry because usually when someone buys their home for the first time, they borrow 74 to 91% of their purchase price. So the house price as well as mortgage rates decide the real cost of buying a home in the US. This is why housing market is highly rate sensitive. And if we look at the long-term trend of the Fed fund rate, we can see that this drives the 15 to 30-year mortgage rates. So when the Fed fund rate fall, mortgage rate fall along with it. And when it rises, mortgage rate also gets impacted. And currently, the mortgage rate in the US is about 5.5 to 6.5%, which is not especially high if you look at this long-term trend. But in order to better understand what's going on in the housing market, we need to zoom in to what happened recently. During the COVID years, Fed fund rate was at or near zero, and this also decreased the mortgage rate to about 2 to 2.5%. And since the mortgage rate increased to 5.5 to 6% these days, this created a lock-in effect. This lock-in effect means that owners who bought homes during this 2020 to 21 only pays about 2 to 3% for their mortgage rates. But if they were to move, they need to swap their 2.5% loan for a 6.5% new loan. So they have strong incentive to not move their homes. This is why the US home supply is frozen. And since buyers have to afford these higher home prices as well as higher mortgages, this is having negative impact on the home builder industry. HMI is an index that blends the supply and demand as well as the rate dynamics into one number. And this will explain the housing cycle. And the way to read this is basically whenever the number is above 50, it means the industry is doing well. And when the number is below 50, it is not doing well. And as we can see here, for the past 40 years, the industry has went to several cycles. From peak to peak, we can measure how many years it took for the industry to recover. And as we can see here, the shorter cycles are about 5 years, and the longer ones are about 7 to 10 years. This is why the CEO of TMHC, which is the company that Berkshire acquired, mentioned the 5, 7, 10-year cycles of the home builder industry. And currently, the US housing market has decreased from the peak for about 5.5 years. But it is still unclear that the market will recover soon or this down cycle will go on for another 2 to 5 years. And another way to look at this is just based on the 50 as the standard. So currently we're in the negative territory of this HMI. And because when the cycle is negative, all the stock prices become cheap. So this discussion about the supply and demand, as well as rates and HMI index, all indicate that we're in the negative territory of the 5 to 10-year cycle, can be the first thesis indicating that right now is a good time to purchase homebuilder stocks. Or if you think there's still some time for recovery, at least this can be a good time to search for potential buys. Now let's take a look at the second thesis, which is industry consolidation. This is actually Buffett and Munger's favorite industry trend. Because there are fewer competition, the remaining companies can enjoy higher profits. And some examples are railroads and airlines. But if this industry consolidation is so good, why does Wall Street miss it? The main reason is because it takes years, if not decades, for this thesis to play out. For example, let's look at the US national market share of the top 10 players since the year 2000. As we can see, the market consolidation increased from 18.7% to more recently to 44.7%. Obviously, the market consolidation increased significantly, but this becomes even more meaningful if we look at the local markets. So let's divide the US market into 31 major metro areas between 2009 to 2024. And during this 15-year period, 4 big builders of each metro areas now control above 50% of the local supply. So the oligopoly structure is strengthening every year, and the small builders are going out of business, and the winners are becoming bigger and bigger because of the macro environment since the 2008 financial crisis. But on top of these macro trends, another reason for consolidation is Japanese companies buying up US homebuilders, and the TMHC M&A that we saw by Berkshire is another piece that's consolidating the industry further. And so the consolidation is still accelerating, and this is the second thesis why home builders are attractive these days. Moving on to the third thesis, it is business model upgrade. The traditional home builder business model looks like this. First, you buy the land and develop it by getting the permits and getting the basic construction in order. Next, you build the actual home and then sell it. And because this whole process takes some time, and instead of just building each houses, you're focusing on the whole town level. This process is very capital intensive. So even when home builders show higher accounting profit, they don't have free cash flow that they can return to shareholders. What gets even worse is that this structure is fine when the market is calm. However, when there are large downturns like we saw before, capital is trapped in the unsold homes and dead land for years. And even during these times, the homebuilder has to pay any interest that's incurred to back those projects. This is why, whenever there is a large cycle, many homebuilders go out of business. So this traditional land-heavy model is not so attractive to long-term investors. But the new business model that we're talking about here get rid of the first two steps of the traditional model. They take care of this by getting into an options contract. They only pay about 5 to 10% deposit for the right to build homes in developed lots. So when the market is good, less money is tied up to these projects, and when the market is bad, they can just walk away from those lands. And by using this model, the homebuilder can just focus on building houses and selling them well. So this new business model is capital light, has low financial leverage, less cyclical, and has higher free cash flow. And with this free cash flow, the companies can buy back and become a compounder. And this is not just in theory, because NVR was the pioneer of this business model. Unlike the homebuilder industry, which is very cyclical as we saw before, NVR's share price, which is shown in the orange line here, has increased quite significantly over the years. And the company generates about 30% ROE and 40% ROIC for several decades. And because the company is ample with cash, since 2000, they bought back 70% of the company's share. And the return that it generated for shareholders is 55 times higher than that of S&P 500. Not only this, NVR was the only major home builder that remained profitable even during the 2008 financial crisis. In the past, management in the industry considered NVR to be somewhat of a weird business model. However, because so many companies suffered during 2008 financial crisis, a few companies in the industry started to copycat this business model. And we know that Warren Buffett cares about this business model a lot because all the 5 home builders that Berkshire bought stake in have this land-light business model. And despite these business model changes, there are still obvious risks. For example, the cost can go up, and mortgage rate going up can have direct negative impact on the home builder industry. So the upcycle can take longer than expected. However, despite these risks, we could understand the three reasons why Berkshire is buying these US home builders through M&A and also purchasing their shares in the public market. Now let's move on to how we can invest in this industry. First, what I did is dividing the sector into 6 subsectors in order to better understand it. Also, the Excel file that you will see from now on can be downloaded from the link below the video. Dividing these subsectors is helpful because we can invest depending on our investment goals. For example, if I am a value investor looking to compound my capital for long term, I can look at the home builders, which is going through the down cycle as we saw before. And among these, I can focus on the asset-light models, just like Berkshire is doing. So in this case, even if the industry does not recover right away, the company can survive longer than its competitors, and when the cash flow comes out, they will continue to repurchase its shares at lower price. However, if I'm looking to make more speculative bet on the housing market, then I can actually prefer traditional business model, because here I can enjoy the uptrend ride from the land prices increasing as well as the home prices. So in the Excel file, I laid out the major home builders, and on the right hand side, I indicated some of the asset-light companies that Warren Buffett is focusing on. Moving on, if you're a dividend investor, you can obviously take a look at the REITs, which are having decent dividend yields, and depending on the regional exposure, they can have lower risks. So I also laid out 13 major housing REITs and categorized each REIT between 1 to 4 tiers. So tier 1 is the most attractive and tier 4 is the least attractive, depending on their exposure to different regions and different types of assets that they own. On top of these more traditional single-family, multifamily REITs, you can also take a look at the mortgage financing REITs. Because their stock price has gone down a lot in recent months, several of them are providing more than 10% dividend yields. Another way to play this market is looking at the government deregulation. For example, Fannie Mae and Freddie Mac are currently delisted since the 2008 financial crisis. But if you're in the US, you can purchase these stocks through the OTC market. As Bill Ackman and Michael Burry have indicated recently, this deregulation play can create high return in short period of time. In addition to the 3 markets that we saw just now, you can take a look at 3 additional subsectors. For example, in the real estate tech, the share price of Zillow has gone down more than 50% because the market is not only worried about the housing market, but also worried about the software and internet platform companies because of the higher risk from AI development. And landowners and NPCs are holding companies that own large parcels of land. And some companies like HHH and JOE are going through structural changes. So you can find interesting special situations. And the way I actually invest in these companies are studying all these 6 categories and diversifying. So I'm focusing on about 50 stocks that are filtered by business model, management incentive, free cash flow, as well as other quantitative and qualitative factors. And for the tier 1 to 2 companies, I already calculated the target prices. So even if some companies' stock prices are not cheap enough, as the market fluctuates, I can go into new positions when some companies' stock price falls. And currently, I'm investing in about 5 stocks among these 50. And some resources I'm providing to you guys. First one is free. You can download the Excel file which has the list of companies with basic information and categorizations. And for the paid service, you can access my research on these companies with specific target prices that I use to invest. But on top of this, you can actually take a look at the dividend portfolio that I'm managing with weekly updates. So whenever I buy into new position, you can directly see which ones I'm buying and at what prices. Please check out the section below, and I'll see you guys in the next investment analysis. Thanks guys.